Welcome to our in-depth exploration of one of the most significant financial crises in history, the Wall Street crash of 1929. This catastrophic event marked the beginning of the Great Depression and reshaped the economic landscape of the United States and the world. The Wall Street crash of 1929, commonly known as Black Tuesday, occurred on October 29, 1929, but its roots can be traced back several years earlier. 1. Preconditions: post-World War I exuberance, rapid industrial growth, rising stock prices, speculative buying. 2. Stock market boom. By 1929, the Dow Jones Industrial Average had increased by more than sixfold in just 5 years. 3. Margin buying. Investors bought stocks on margin, borrowing money to purchase more stocks than they could afford. 4. Overconfidence. Many believed the market could only go up, leading to rampant speculation. In October 1929, the market began to show signs of instability. On October 24th, known as Black Thursday, panic commenced as selling accelerated. The financial machinations in this era were complex. Let's delve into the timeline. On Black Thursday, the market lost 11% of its value at the opening bell. Panic selling ensued. The following Friday, prices stabilized somewhat, but the relief was short-lived. On Monday, another round of panic selling brought a further decline. Black Tuesday, October 29, 1929, is often seen as the true beginning of the Great Depression. The volume of trades overwhelmed the stock ticker, delaying reports of prices. By the end of the day, the market had lost an additional 12% of its value. Let's break down the aftermath of Black Tuesday. Economic impact: massive job losses, factory closures, bank failures, international ripple effects, similar crashes in European markets, global economic downturn, regulatory changes. In response to the crash, the U.S. government enacted significant financial reforms such as the Glass-Steagall Act and the Securities Exchange Act of 1934. For instance, the Dow Jones Industrial Average did not return to its pre-crash levels until 1954, nearly 25 years later. Let's address some common questions you might have. What were the main causes of the Wall Street crash? Several factors contributed, including excessive speculation, weak regulatory oversight, and an overinflated stock market fueled by borrowed money. How did the public and government react immediately after the crash? Panic, widespread bank runs, significant loss of personal wealth, and eventually, federal intervention with financial reforms. Could such a crash happen again today? While the exact circumstances might not repeat, markets are still susceptible to crashes. However, modern regulatory frameworks and risk management practices aim to mitigate such extreme scenarios. What lessons were learned from the crash? The importance of financial regulation, the dangers of excessive leverage, and the need for transparency in financial markets. Now, let's visualize the impact on GDP and unemployment rates before and after the crash. As seen, the GDP fell sharply while unemployment rates soared, reaching nearly 25% by 1933. To wrap up, the Wall Street crash of 1929 serves as a somber reminder of the power and perils of financial markets. The crash did not happen overnight. It was a result of a myriad of factors, including excessive speculation, leverage, and market euphoria. Thank you for joining us on this detailed exploration of the Wall Street crash of 1929. If you have any questions, feel free to leave them in the comments. Don't forget to like, share, and subscribe for more finance video tutorials.